Over the last 5 years, the S&P 500 has nearly doubled. Looking at that trajectory, it is easy to assume that the average person with a brokerage account is successfully building wealth. The reality is much bleaker. Despite those gains, 75% of regular retail investors lose money. Wall Street professionals have even coined a term for them: capital donors. This chart visualizes that wealth gap. While the majority of small-scale investors are losing their principal, the wealthiest 10% of Americans now control nearly 90% of the entire stock market. Most people assume this dominance is the result of superior stock picking, or a unique ability to predict which company will become the next trillion-dollar giant. But the real secret to elite wealth management is much more clinical. Success at this level depends less on finding winners, and more on systematically identifying and removing every possible source of risk. For the average person, investing starts with stability. That usually means buying into blue-chip companies like Apple, massive global entities with a long history of surviving market volatility. The standard strategy is to buy these shares, hold them for years, and allow the power of compounding to grow the account balance slowly. This graph illustrates the concept of naked risk. Because the retail investor has no secondary protection, their portfolio drops in exact lockstep with a market crash. If the index falls 20%, their wealth disappears at the same rate. This total exposure often leads to emotional decision-making. When a crash occurs, the fear of losing everything causes retail investors to panic and sell their shares at the exact moment the market hits its lowest point. This cycle is why regular people become capital donors. They hand their wealth over to the protected professionals on the other side of the trade, while waiting for the price to bottom out. Millionaires approach the market differently. They stop trying to guess where the price is going, and instead use financial contracts called derivatives to protect the capital they've already earned. Mark Cuban provided a masterclass in this during the dot-com era. After selling his company to Yahoo, he was holding $1 billion in Yahoo stock, just as the 1999 bubble was starting to look unstable. He used an options collar to secure his fortune. He bought a put option, which guaranteed he could sell his shares at a set price, even if the market crashed, effectively creating a floor. To pay for it, he sold a call option, which capped his potential profit if the stock went higher. When Yahoo stock eventually cratered, Cuban didn't lose any of his principal. His wealth hit the mathematical floor he had built and stayed there, while everyone else took the full hit. Billionaires take this logic even further by investing in quantitative hedge funds, where the goal is to extract profit from the market regardless of its direction. Jim Simons and his firm, Renaissance Technologies, pioneered this approach by replacing human intuition with complex mathematical models. They don't care about gut feelings or corporate news. They only care about data. These algorithms process massive datasets, such as satellite imagery of rainfall over the Midwest. By identifying how a change in weather correlates with the future price of fertilizer or grain, they can execute trades before the rest of the market even sees the signal. By identifying these microscopic inefficiencies, these firms turn trading into a game of statistical probability. This allows them to find an edge and generate returns even in environments where the average investor is losing money. For the ultra-rich, a steep market downturn is often less threatening than the annual erosion of their capital through the tax code. This is where the family office comes in. It is a private team of lawyers and strategists whose sole job is to manage and optimize every dollar for a single family, moving far beyond simple stock picking. One basic strategy they employ is tax loss harvesting. They deliberately sell underperforming stocks to lock in a loss on paper, which they then use to cancel out the taxes they would otherwise owe on their winning investments. But the most powerful tool for erasing risk is a strategy used by Elon Musk called buy, borrow, die. Musk owns a massive amount of Tesla shares, but selling them would trigger an enormous tax bill. Instead of selling, he uses his shares as collateral to take out massive bank loans. This provides a steady stream of cash to fund his life, but because it is technically debt, it isn't taxed. He gets the liquidity of his wealth without ever triggering a taxable event. This strategy effectively bypasses the standard rules of income. By utilizing their wealth through debt rather than sales, the elite ensure their capital remains intact and grows indefinitely, undisturbed by the tax system that affects everyone else. The stock market is actually 3 different games played on the same field. Retail investors take on naked risk, millionaires use hedging to cap their losses, and billionaires use complex engineering to avoid the rules of the system entirely. The ultra-rich use the stock market as a preservation tool, utilizing these advanced strategies to ensure their capital outlasts their lifetime, rather than gambling it on a lucky break. Understanding this gap is the first step toward actual wealth. By focusing on long-term, diversified compounding instead of following social media hype, you can stop acting as a capital donor and start playing a game that actually works in your favor.